All right. So thank you everyone for joining the session, and I hope that my voice is audible to everyone now, and the screen is visible as well. Okay. So today we are again going to do two or three different past papers. It is going to be a very helpful session for everyone. Yesterday, we did solve entire December 2025 mock exam live in the class. We also discussed a lot of concepts, and today as well we are going to do a lot of you can say content. We are going to cover a lot of content. We are going to discuss a lot of concepts as well. Okay. But before we start, there is something that I have to show it to you, discuss with you, and for which I will need some time. And afterwards, we are going to start with the session as well. Okay. All right. So, first thing to show to everyone is this top 50 questions list. I hope that by now everyone has this top 50 questions list with them. Okay. If you listen to the recent high achievers, there have been uh, a lot of high achievers recently whom we interview and put their interview on VIFHE's YouTube. So one thing that was common with all the students was that in the last 15 or 20 days, in the last 15 to 20 days, they just focused on completing this list of 50 questions. Okay. So you can see serial number over here. Then you can see the question name. Then you can see the question number and the year in which the particular question was tested. You can see the marks column here. You can see the topic over here. And this last thing is very important, portal tab. Where on the portal will you find the relevant video solution? Okay. So this portal tab thing is very important, and this is specifically the name of the place where you can find this relevant lecture for viewing. All right. So these are the list of 50 top 50 questions that I always recommend my students to solve. And if you solve the same question a couple of times, two times, three times, you feel a lot better. Okay. This top 50 question list has a lot of questions that you can solve. They cover almost all the topics that we have. And after this list, there are some links. Okay, there are some links as well. Do you all have this top 50 question list with you? Yes or no? Do you all have this top 50 questions list for you updated for March 2026 attempt? Excellent. So this is one important thing that you have to do. This is a list of top 50 questions. This is a list of top 50 questions, and if you do them twice or thrice, you can easily pass your exam paper. Then there are certain links that you can use. For example, this is the main Google Drive link. You have past paper analysis. You have old past papers. You have the 67 pages booklet. You have past paper summary. You have past papers and relevant material tab, and in order to download live class spreadsheet files, you have different links available over here as well. Then these are some of the syllabus areas that are not tested very regularly, but since they are part of your syllabus, you must know them as well. Okay. And I have given a particular reference from where you can cover the above relevant content. Okay. Do remember that recent game changer and webinars tab is very important. Recent game changer and webinars is a tab on the portal over which I have covered a lot of content. These videos are very important. These videos are very important. These videos are very important because they cover different types of concepts and all are explained while solving a particular past paper. So you all must have this spreadsheet file. If you are someone who still does not have this file, you need to have it. Okay. Google Drive links are mentioned, non-frequently tested topics are mentioned, and then this is my contact number. If there is some student who is watching recording of the session, or if there is a student who is not enrolled till now, you can contact me on my number to obtain the list of top 50 AFM questions for March 2026 attempt. Okay. So, and these are the relevant ranks that we have got from recent results. Is this first file clear to everyone? If there is any student who does not have this first file, they have to WhatsApp message me. Do we have someone who does not have the list of this top 50 AFM questions with them? Okay, so this was the first thing that I wanted to discuss. You have to be very sure, you have to be very sure that this is with you and you are covering these questions. If someone practices only and only and only this file, if someone practices these 50-51 questions twice or thrice, they are surely going to pass. Okay, provided they do cover the questions while watching the video, because during the video I have covered a lot of concepts that are relevant as well. So if you do these questions, you pass. Okay. If you follow this particular file, you pass very easily. If you follow this particular file, you pass very easily. So this was the first thing that I wanted to tell you. Is it okay, everyone? All right. Now, the second thing that we have, there might be some students who are not enrolled, who are not registered, who are not part of the paid group till now due to some reason. If you are someone who is still not part of the paid group due to some reason, being part of the paid group is essential. But if you are not part of the paid group, you can still use these some of these sessions, go one by one. And do you all have this file with you? All right. So in this file, these are recent game changer and webinars. Some concepts are very tricky. For example, collars, swaps. So if you use this particular file or you use the content on the portal directly, you get a good grip over different concepts. Now this video is very important. Serial number 11. Because it explains specs, dark pool, tick size, tick value, M&M proposition and loan repayment. Yes, other videos are important as well. Every video is important. Every video gives you some knowledge. If you don't have this file, you can still contact me. Okay? All right. Now the next thing is, okay, do pay, do so also need to follow this one. No, if you have covered all the 6 important tabs from the portal, you don't need to follow this file. The file is very same. Okay, it is same. Okay, now most important tabs from portal. If you are paid student, most important tabs from portal. There are 6 tabs that I have highlighted again and again. Correct? There are 6 tabs that I have highlighted again and again that you must cover. If you want top 50 questions list or list of some free webinars, if you are not paid, you can WhatsApp me. And I am sharing my WhatsApp number. I need to look into it and then mention it. And after this, we are going to start solving the questions. So WhatsApp number is plus 971 58 506 8907. Okay, plus 971 58506 8907. This is my WhatsApp number if you don't have this. Okay. Now, what is the agenda for today? Agenda for today is to practice interest rate hedging area. And after that, after doing around 2 questions from this, we will see how much time we have. If we have more time, we can probably practice foreign currency hedging. We can probably practice mergers and acquisitions, or we can probably practice corporate reconstruction area. Is it fine, everyone? So now shall we start? Have you all downloaded December 2021 past paper from Google Drive? Yes or no? If you have not downloaded December 2021 past paper from Google Drive, please download it. I am giving you a couple of minutes. You all have the Google Drive link with you. You have to simply go to the Google Drive. You have to go to Google Drive. From Google Drive, you have to go to past papers and relevant material tab. And in this particular folder, you will find December 2021 past paper and relevant material tab. So download whatever you have from here. I am giving you one more minute and we are going to solve December 2021 Brendan Company in the first place. Okay. If you don't have the link, you can WhatsApp me. All right. If you don't have the link to the Google Drive and the relevant material, you have to WhatsApp me. Shall we start? Okay. Last 1 minute, and after 1 minute, we are going to start solving the first question of the day. All right, let's start. Let's solve the first question of the day. I will share the screen. We will first review the entire question. We will first read the entire question, and it is in front of you now. So we are going to solve this first question. The session is going to be very helpful if you struggle in hedging area. If you actually struggle in hedging area, if you find hedging difficult, this session is going to be helpful for you. Okay. So I hope that you all have downloaded this specific question. I hope it is visible in front of you on your screens as well. If you don't have the free resources with you, if you need free resources, you can WhatsApp me. I am just mentioning my number for free resources. WhatsApp me, and the number is +971 58506 58506 8907 8907. Okay, +91 58506 8907. So if you are someone who is taking the session for the first time, if you are someone who is not enrolled, you can WhatsApp me as well for the free resources. Now I want all of you to be with me all the time. This is very important. Your hedging area covers a lot of marks. Okay, hedging is very important for you. Hedging area is very important for you, and you have to be very focused. If you want to grip hedging today, you need to be very focused. Okay. I have already mentioned my number on the screen. You have it in front of you. Uh, Please confirm me if the voice is loud and clear. Please confirm me if the number is clearly visible to everyone. Please confirm me if the question is visible on the screen as well, so that I am sure that there is nothing wrong and I can start with the solution, with solving the question. Okay. If there is any problem with the voice, you have to let me know right now. All right, excellent. So let's begin our session with this particular question. Okay, let's read it very carefully. Okay, in exams, we need to read all the exhibits and start the question, or for each requirement, there will be separate exhibit. There will be separate exhibit for each requirement. But ideally, you must read the entire, all the exhibits before answering anything. Okay, let's begin. It says Brandon Company is a holding company operating a small chain of luxury department stores in city center locations throughout the Eurozone. Under the existing structure, the stores are grouped into a number of regional subsidiaries, each with their own head office and treasury function. The board plans to undertake a restructuring exercise in response to a significant decline in revenue over recent years. This will involve closing unprofitable stores within the Eurozone whilst expanding into other more profitable locations worldwide. The proposal represents a significant expansion for the company and will be financed by a combination of debt and equity. The restructuring is due to be discussed at the upcoming board meeting, including the possibility of centralizing the treasury function. Now, one important or the first important thing to note is that right now the treasury department is decentralized, and now they are considering centralizing the treasury department. Now, if they are considering to centralize the treasury department and they are currently decentralized, there can possibly a theory question involving the benefits of centralization and decentralization of the treasury department. And such questions have been covered, correct? In the theory booklet, if you look into the 67 pages theory booklet, if you look into the 67 pages theory booklet, you will actually find a comparison of centralized and decentralized treasury department. Yes or no? Okay. Assume today's date is 1st of November. Now, in case of interest rate hedging, this is the first and the most or one of the most important informations, which is what is the date today. So they are saying that you have to assume that it is 1st of November today. You have to assume that it is 1st of November today. This is the first important information that you are provided. Brendan Company's treasury manager predicts a short-term loan of 36 million will be required next year. So we have loan amount. What is the amount of loan? Loan amount is 36 million. Okay. What is the date today? The date today is 1st November. Okay. Will be required next year on 31st of January. Now, what is the loan start date? Loan start date is 31st of January, or you can also say 1st of Feb. 1st of Feb or 31st of January. So this is the second important information that we have, that the amount of loan will start on 31st of January. How many months from today? November, December and January. 3 months. Okay. So there is a 3 months gap. Okay. After 3 months from today, we are going to borrow. So this interest rate hedging question is about which case? Deposit or borrowing? This question is about borrowing. This question is about borrowing. Okay. All right. It further says to fund an investment in non-current assets as part of the overseas expansion, the loan will be repaid on 31st of May. So now loan end date is given to us as well. Loan end date is 31st of May. Loan end date is 31st of May. Is it clear, everyone? Is it crystal and clear? So this information is very important when it comes to the computational area. Loan starts on 1st of November. Sorry, today is 1st of November. Loan starts 3 months from today on 31st of January. And then you repay the loan on 31st of May. Now, what is the loan time period? What is the loan time period? What is the loan time period? It is 4 months. Correct? Feb, March, April, May. And what is the duration between today and the loan end date? If I count from today, I have to repay the loan 7 months from today. Agreed? So if I count from today, I have to repay the loan 7 months from today. All right. So in terms of FRA, it is generally mentioned as 3-7. In case of forward rate agreements, you all know forward rate agreements. So if the question is testing you about FRA, FRA will be 3-7 FRA. What does 3-7 mean? 3 denotes the time of start of the loan from today, and 7 denotes the end of loan from today. Is it clear, everyone? FRA have 2 digits written, so it will be 3-7 FRA. FRA are forward rate agreements, and in this case, if you go for FRA or a forward rate agreement, it will be 3-7 FRA. 3 denotes the date on which the loan will start, and 7 denotes the date on which the loan will end. Okay? All right. Now, do remember that this is the case of borrowing. You have 2 types of questions: borrowing and deposit. We will practice one type of each question today. Then it says Brendan Company can borrow at the central bank base rate plus 40 basis points. So you can borrow from a bank at central bank base rate 40 basis points. 40 basis points is actually 0.4%. Okay. 100 basis is 1%. 100 basis is 1%. So right now you can borrow at central bank base rate plus 40 basis points. The central bank base rate is currently 5.7%. So the current rate is 5.7%. Current central bank base rate is 5.7%. So what is your borrowing cost right now? My borrowing cost right now is 6.1%. If central bank base rate is 5.7%, 5.7 plus 0.4 gives us 6.1%. So currently we can borrow at 6.1%. All right. Interest rates have been relatively volatile over the last few years, and the finance director is concerned that the central bank base rate could increase the base rate. Central bank could increase the base rate. Central bank could increase the base rate to 6.6%. Do remember that if central bank increases the base rate to 6.6%, which means that this 5.7% will become 6.6. And what will be my borrowing cost? It will be 7%. If the central bank base rate increases to 6.6%, my borrowing rate will be 6.6% plus 0.4%, that is 7%. Okay, this is very important. Okay, between now and 31st of January, in response to expectations about inflationary pressures within the economy, recent media reports have also speculated on the possibility of a reduction in the base rate. Now, always remember that we use different hedging techniques. What is the purpose of hedging technique? Hedging helps us to reduce the adverse impact of any uncertain future events. Right now, what are we worried about? Are we worried about increase in the interest rates, or are we worried about decrease in interest rates? We are worried about increase in interest rates. Always remember that if the question is about borrowing, if the question is about borrowing, you are worried about increase. You are worried about increase in interest rate. In case of deposits, it is opposite. In case of deposit, you are generally worried about decrease in interest rates, because in case of deposits, if the interest rates decrease, your overall income will reduce. So you have to remember this point. Okay. All right. Now they are giving us some details about hedging. Okay, again, if there is some student who who is not enrolled, I will appreciate, I will rewrite my number somewhere below, so that if anyone needs any free resources, if anyone needs free resources, if you are not enrolled, you have to WhatsApp me at my number +971 58506 8907. Okay. All right. So now let's come to the hedging techniques. Brendan Company's treasury manager would like to investigate smoothing as a technique to manage the company's future exposure to interest rate risk. But for the purposes of this transaction is considering the following hedging possibilities. with the objective of minimizing exposure to interest rate risk. Now, what is smoothing? Can someone tell me what is smoothing actually? Okay, balance between fixed and variable rate loan. Is it always a loan? What is smoothing? How many of you know what is smoothing? Interest rate hedging. What type of interest rate hedging? Quickly, quickly, quickly. Swaps. No, it is not a swap. Do you all know what is smoothing, or shall I tell? Okay. Now, actually, basically, there are two things. When you either borrow or deposit, when you borrow funds or you deposit funds, you can obtain them at a variable rate or a fixed rate, correct? For example, if I am borrowing from someone, I can borrow at a fixed rate of, let's say, 10% or 12%, in which case the rate will never change. Or I can borrow at a variable rate, which will be LIBOR plus XYZ percent or central base rate plus XYZ percent. Do you all agree? Do you all agree? Do you all know that there are two things, variable and fixed rate? Now, in case of smoothing, what we do, if we, for example, if we need 100 rupees, let's assume that it is a borrowing case. Smoothing also applies in case of deposits. So if we need 100 rupees, we will borrow 50 at a variable rate and 50 at a fixed rate. Okay. I repeat, in smoothing, if I have to borrow, for example, let's say 100 rupees or $100, so I will borrow certain portion at a variable rate and certain portion at a fixed rate. Okay. For example, I will borrow 50% at a variable rate and I will borrow the rest 50% at a fixed rate. Now, how is it going to help me? Let's assume that the variable rate increases. Let's assume that after my borrowing, the variable rate increases. Okay. Let's assume that after I borrowed funds, the variable rate increases. So this increase in variable rate will not impact me too much. I haven't borrowed 100% amount at a variable rate. I have borrowed 50% amount at a variable rate only. So even if the variable rate increases, my entire borrowing cost will not shoot up too much. Yes, it is going to increase, but it is not going to increase too much. Why? Because I haven't borrowed 100% amount at a variable rate. I have borrowed 50% amount at a variable rate only. So the increase in variable rate can increase at any point. Even if it does increase, and even if my borrowing cost increases, the impact will be smoothed out. Do you all agree? Do you all understand what I am trying to say? If I borrow 100 rupees at a variable rate and the variable rate shoots up, my cost is going to increase too much. But if I borrow 50% at a variable and a 50% at a fixed rate, even if the variable rate increases, yes, there will be an impact on my variable amount, but the overall impact will not be too much because I have borrowed certain amount at a fixed rate as well. Okay. No, Fahad, the ratio is not fixed. It depends upon your judgment. Okay. Do you all understand? So if the variable rate increases, since I borrowed certain amount at a fixed rate, it will not be impacted, and hence my overall borrowing rate will increase, but not too much. Likewise, what if the variable rate decreases? Likewise, what if the variable rate decreases? If the variable rate decreases, if the variable rate reduces, if the variable rate decreases, yes, my borrowing cost will reduce, but I will not be able to take 100% advantage of reduction in variable rate because 50% of my loan amount is at the fixed rate. Okay. So actually borrowing certain amount at a fixed and borrowing certain amount at a variable smooths out the fluctuations. Okay. It is actually a technique to reduce the impact of increase or decrease in rates. It smooths it out. Because if I borrow 100% amount at variable rate, and if the variable rate increases, the borrowing cost is going to shoot up too much. Or if the borrowing rate decreases, it is going to reduce too much. But if I borrow 50% at variable and 50% at fixed, yes, if the variable rate increases, only 50% cost will increase. And if the variable rate decreases, only 50% cost will decrease. So actually I will not be exposed to 100% disadvantage, but I will not be able to take 100% advantage of reduction as well. Is this concept clear to everyone? This can come for a 4 to 5 marks theory. This concept can be tested for a 5 marks theory. Okay. So you will have to write it in your own words that what is actually smoothing. Yes, it is a type of hedging technique. Anyways, so they just mentioned a word smoothing to ask probably a theory question, and now they are giving us the different hedging techniques. Forward rate agreements, interest rate futures, and options on interest rate futures. The following data is available for each of the above. The following data is available for each of the above. The first one is FRA or a forward rate agreement. Okay. Now, if we read the requirement, it says explain how the functional areas of a treasury department could add value to Brendan company restructuring plan. For each functional area, discuss the advantages of a centralized treasury department. You see, I told you that they probably want you to list down the advantages of centralized treasury department and ask relevant theory. Again, if you carefully read the 67 pages booklet and the 64 pages booklet, you can expect to get around 4 to 5 marks very easily. Second one is recommend a hedging strategy for 36 million loan based on the hedging choices the treasury manager is considering. If the central bank base rate increases to 6.6%, support your answer with appropriate calculations. So this is computational, this one is theory, this is computation, and the third one is theory again. Briefly explain what is meant by smoothing and how this technique could be used to manage Brendan company's interest rate risk. You can easily get 3 out of 3 over here. Smoothing is very easy and we have just discussed it. Okay. So this 15 marks area, the computational area is the most important. You have to use all the hedging techniques and explain how you will hedge it. So we have forward rate agreements with us. We have forward rate agreements with us. Now tell me which FRA or which forward rate agreement are we going to use? Which FRA are we going to use with proper reasoning so that those students who don't know are able to get an idea? 3-7. Why 3-7? Why 3-7? Okay. We will go for 3-7 forward rate agreement. 3 is the start and 7 is the end. Okay. And the rate over here is 5.9%. What does this rate actually mean? What does this 5.90% mean? Does it mean that if I go for a 3-7 FRA, does it mean that if I go for a 3-7 FRA, I will be able to borrow funds at 5.90%? Does it mean that if I go for a forward rate agreement of 5.90%, will I be able to borrow funds at 5.90%? Yes or no? Do remember that the hedging techniques will lock your base rate only. Excellent. Excellent. I can see good responses. If I go for a 3.3-7 FRA, which mentions a rate of 5.90%, it actually means that my effective cost is going to be 6.3%. Do remember that FRAs lock. What do they lock? Base rate only. Base rate. Base rate. So FRA is going to lock your base rate only. Okay, one more thing. The actual party from whom I borrow funds and the party with whom I do the FRA agreement, are both of these parties always same or can they be different? I repeat, if I am borrowing from someone, can the FRA forward rate agreement party, the party with whom I will do an FRA agreement, be different or same? It can be different, yes or no? Excellent. It can be different. Okay. So my general assumption is that FRA party was a different party because it is a very separate agreement from the basic agreement. You have to remember this, that the FRA agreement is a separate agreement. So you have to be careful. You have to do two calculations. Now let's solve this for FRA. Now one thing is original borrowing. Original borrowing. Okay. Original borrowing means the party from whom I have borrowed the funds. Original borrowing means the party from whom I borrow the funds. If the base rate increases from 5.7 to 6.6%, if the base rate increases from 5.5 to 6.6%, which I was worried about, so my borrowing cost will be how much? My borrowing cost will be 6.6% plus 0.4%. Why? Because I can borrow at the base rate, I can borrow at the base rate plus 40 basis points. So base rate plus 40 basis points means 6.6% plus 0.4%. 6.6% plus 0.4% is 7%. So from the original party, I will borrow at 7%. What is the amount of loan? Amount of loan is 36 million. Amount of loan is 36 million. What is the borrowing period? Borrowing period is 4 months. Okay. So can someone tell me what is 7% into 36 million into 4 over 12? 4 over 12 is the borrowing period. 4 over 12 is the borrowing period. Okay. 36 into 4 over 12 into 7% gives us 0.84. And if I multiply it with 6 zeros, 1 into 6 zeros, 840,000. So my original borrowing cost is going to be 840,000. My original borrowing cost is going to be 840,000. Is this clear? Now, if I've entered into FRA, if I have entered into an FRA agreement, I will get a compensation. I will get a compensation based on FRA. I will get a compensation based on FRA because FRA at 5.90% means that the party with whom I entered into an FRA agreement locked my base rate at 5.90%. They also assured me, they gave me a guarantee, they gave me a guarantee, they gave me a guarantee that if in any case the interest rate or the base rate goes beyond 5.90%, they gave me a guarantee that if any case the base rate goes beyond 5.9%, they are going to give me an equal compensation. So what is the compensation percentage? Base rate is 6.6%, which is 5.9% compared to 5.9% is 0.7% more. So they are going to compensate me for this percentage multiplied by 36 million multiplied by 4 over 12. So 6.6 minus 5.9 is 0.7. 0.7% into 36 million into 4 over 12 gives us 84,000. Correct? This is the compensation that I will receive. This is the compensation that I will receive because I will tell them that I have paid more because the base rate has increased. So 840,000 minus 84,000 gives us 756,000. 756,000. This is my net borrowing cost. Okay. What do you guys suggest? Shall I solve the question in a spreadsheet or is this better? Because the question is in front of you. I believe this will take less time, correct? You already have a lot of Excel solutions with you. But if this is better, correct? Because the question is in front, so we can quickly solve it and the information is in front of it and I'm also marking it. Okay. So 756,000 is going to be my net cost for the 4 months period. Okay. Now, there are two methods to calculate the effective rate. There are two methods to calculate the effective rate. One method is very simple. If the FRA is 5.90%, if the FRA is 5.90% and the risk rate, company specific rate is 0.4%, your effective cost is going to be 6.30% for sure. Okay. All right. Or otherwise there is one more method. And the other method is that this is the borrowing cost for 4 months. This 756,000 is borrowing cost for 4 months. This 756,000 is borrowing cost for 4 months. Correct? If I want to calculate effective annual rate, what I will do is that I will say 756,000 is cost of 4 months. 756,000 is cost of 4 months. So if I divide it by 4, what I get? 756,000 is the cost for 4 months. So if I divide it by 4, I get monthly cost. Correct? I get 1 month's cost. 756,000 is the cost of 4 months. So if I divide it by 4, I get 1 month's cost multiplied by 12. Multiplied by 12 gives me total cost of entire year divided by the total loan amount, which is 36 million. So this way I can also get the effective cost 756,000 divided by 4 multiplied by 12 divided by 36 million into 100 is going to be 6.30% as well. Is this clear, everyone? Is this clear, everyone? I don't want any single student to have any confusion. If you attend today's session and if interest rate hedging comes in your exam, you are definitely going to pass because we are going slow, steady. We are going to understand all the concepts. The session is going to be very beneficial. Excellent. Good. Okay, one more thing, one more variation that is asked in the exams. What if, what if, what if, what if instead of base rate increasing, it decreases? Let's say instead of going to 6.6%, instead of moving from 5.7 to 6.6%, instead of going from 5.7 to 6.6%, let's say what if the interest rate decreased to 5.5%? Let's say what if the interest rate decreased to 5.5%? Instead of going from 5.7 to 6.6, it decreased by 2 points and became 5.5%. Now in this case, what will be your original? Okay, we have a question. Why are we dividing by 4? Okay. Divya, in order to calculate effective annual rate, do you know what is effective annual rate? Effective annual rate is a rate which shows that what if the borrowing was for an entire year, what will be your actual cost? Now, Divya, 756,000 is cost of 4 months agreed. 756,000 is cost of 4 month agreed. So if I divide 756,000 by 4, I will get cost of 1 month agreed. I will get cost of 1 month agreed. 750, okay. And multiplied by 12 gives me annual cost. So this effectively, the above bracket is your annual cost. Above bracket is effectively your annual cost. Okay. All right. Now, what if the rate is 5.5%? What will be my original borrowing? What will be my original borrowing cost? It will be 5.5 plus zero point 0.4, correct? Multiplied by 36 million. 5.5 plus zero point 0.4 is 5.9. 5.9% into 36 million into 4 over 12. It will be how much? 708,000. Okay, let me come back to 6.3%. 6.3% is known as effective cost. It is known as effective cost. Effectively, what you are paying? Effectively, on this borrowing, I am paying 6.3%. Okay? Do you now understand? Effectively, entering FRA or a forward rate agreement locked my base rate, and my borrowing rate was base rate plus 0.4%, so it becomes 6.3%. Okay, what if the rate decreases to 5.5%? My borrowing cost will be 708,000. Yes or no? If the rate decreases to 5.5%, my original borrowing cost can be calculated as 5.5 plus zero point 0.4 multiplied by 36 million multiplied by 4 over 12. Yes or no? So 5.5 plus zero point 0.4 is 5.9. 5.9% multiplied by 36 million multiplied by 4 over 12 is going to give you 708,000. Now, if in this case you have entered into FRA, what will happen? If in this case, if you have entered into FRA of 5.9% and the base rate has decreased to 5.5%, what will happen? We pay. Excellent. If you have entered into FRA, of 5.9% and the base rate decreases instead of increasing, you have to pay to the FRA party. So if my base rate was locked at 5.90%, actually it dropped to 5.50%. I will need to compensate the FRA party for 0.4%. And if I compensate FRA party for 0.4%, so 0.4% into 36 million into 4 over 12 is 48,000. And 48,000 plus 708,000 is again 756,000. So do remember that in case of FRA, FRA helps me what? FRA helps me lock my overall cost and helps in better planning. Okay, let me explain again. Charity, what is a FRA? FRA is a forward rate agreement in which you lock the base rate, correct? Do you agree? Locking the base rate means that some party, Mr. X, Mr. Y, Bank A, Bank B, Bank C, financial institution A said that your base rate is going to be 5.9%. If the actual base rate increases and goes beyond or above it, we will pay you the difference. If it decreases, you are going to pay us the difference. Okay. Is majority clear over this? Can I move to the futures? I need 30, 40 yes so that I can move forward. 3, 4, 5, 6, 7, 8, 9. How did you get? I assumed, Divya, I assumed that what if it reduces? Is it part of the FR working to always calculate for the? Yes, it is. All right. Is majority clear? I need 10 more yes answers. If 10 more people say they are comfortable, I can move on so that we have at least 40 confirmations. Okay. So FRA or forward rate agreement locks your base rate and it is ideal if you want to make a proper plan. Okay. Does it mean that the effective rate will always be the same? Yes, it is going to be always, it is always going to be same. It is always going to be same. Yes, we are going to compensate the FRA party for 48,000 because FRA party said that your base rate will now stand at 5.9%. If the actual base rate goes lower, you will pay us. If it goes higher, we will pay you and compensate you. Okay? Excellent. Now let's move to the other part, which is futures. Now, futures are very interesting. Futures are very interesting. So now is this important? Is this important? It says 3-month dollar futures. Is it important? And if anyone has just joined, please do WhatsApp me on my number +971 5850 68907. Okay. Yes, it is important. It helps me calculate the number of contracts. So we have 3-month dollar futures. 3-month dollar futures. One more thing. Is this currency important? Is this currency important? Don't be wild. Use your brain and then answer. Is this currency important in every past paper question? Currency in your exam, if the case of borrowing or deposit is of dollars, currency is dollars as well. Currency is generally in your exams, in AFM, currency is very important when it comes to foreign currency hedging. Currency is very important when it comes to foreign currency hedging. In case of currency hedging, there are two types of hedging in your syllabus: foreign currency hedging and interest rate hedging. So in case of foreign currency hedging, the contract currency is very important. In case of foreign currency hedging, contract currency is very important. In case of interest rate hedging, contract currency is not that important. So right now we are doing interest rate hedging. Our loan is in dollars and the future contracts are in dollars as well. They are 3-month contracts and the contract size is $500,000. It helps me to calculate the number of contracts. Okay. Now, the first thing that we can do is we can calculate the number of contracts. Calculation of number of contracts is not difficult. Over here, if you have to calculate number of contracts, how can you do it? Number of contracts can be calculated as loan amount divided by contract amount Loan amount divided by the contract amount multiplied by loan period divided by contract period. Okay. And I believe, I believe that majority of you logically understand this. Is there any enrolled, paid, registered students WhatsApp group student? Is there any paid student who has portal access who does not logically understand the adjustment we make? I hope that everyone logically understands. So it is important that you logically understand why we multiply with loan period over contract period. Yes or no? Okay, let me explain it very briefly. Listen carefully, everyone. If let's say loan is of 100, contract amount is 50, loan period is 3 months, and contract period is 3 months as well. Loan amount is 100, which means that you have to hedge 100 rupee. One contract hedges 50 rupee or $50. One contract, if you buy one contract, it is going to hedge $50. Loan and contract period are same. So how many contracts will you need? 100 over 2, which means 2 contracts. Agreed? Is this clear? Is this first case clear? If the loan period and the contract period are same, and if I go for 2 contracts, let's say this is loan period of 3 months, and if I have to hedge 100, and let's say the first contract is of 50, which covers a 3 months period, let's say this represents a loan period of 3 months but a loan amount of 100. So 2 contracts will be sufficient. One contract of 50 will cover half and the other contract of 50 will cover half. Correct? Oh, sorry. Yes, yes. Is this clear, everyone? Any confusions over here? Any confusions over here? If loan amount is 100 and if the contract amount is 50 and if the loan and the contract period are same, you need 2 contracts. Is this clear, everyone? Please confirm me before I move on. Any confusions? Anyone having any confusion, talk to me before I move to next example. We need 2 contracts because the first contract is going to cover 3 months, $50, and the second contract is also going to cover 3 months and $50. Now what if FCCCIR So the question, why our contract period is 3 months? Divya, over here we are taking some examples. One of the students had a confusion, so I am making some examples. I am saying if the contract and the loan period is 3 months, is it clear? Is this example clear? It is not linked with the question, neither the amounts nor the contract period. Is this clear, Divya? If you have to hedge 100 and if each contract is of 50, okay, so you will need 2 contracts to hedge entire amount. Mavalia, I guess I am pronouncing correct name. One of the students asked me this query. Are you clear? Okay. What if loan amount is 100 contract amount is 100 as well. Loan period is 6 months and contract period is 3 months. What if loan amount is 100, contract amount is 100 as well? So this means that one contract hedges 3 months period. One contract hedges 3 months period. How many contracts will we need? Mavila, I am sorry if I pronounce your name incorrectly, but I want you to be very clear. Uh, Koseka, I can say Koseka. Koseka, Mivila Koseka. Is it clear how many contracts will we need? Mivila. Okay, Mivila, how many contracts will we need? How many contracts will we need in the second example? Will we need one contract or two contracts? Will we need one contract or two contracts? Will we need one contract or we will need two contracts? Excellent. We will need two contracts. Okay. Why two contracts? Because I want to hedge a 6 months period. 1 month, 2 months, 3 month, 4 month, 5 month, and 6 month. If I go for one contract only, yes, it is going to hedge $100, but it will cover the first 3 months only. Okay, it is going to cover the first 3 months only. Why? Because the loan period is 6 months, but the contract period is 3 months. So if I go for one contract, it is going to hedge $100, but for first 3 months only. So I need two contracts. I need one more contract. Yes or no? I need one more contract. I need one more contract as well. Yes or no? If I have two contracts, I can hedge the entire time period. If I have two contracts, I can hedge the entire time period. Is this clear, everyone? Patience, patience, you need two contracts. You don't need one contract because the first contract is going to hedge the first 3 months only. Your total duration is 6 months. Okay. So in terms of formula, we can say loan amount divided by contract amount, loan amount divided by contract amount, loan amount divided by contract amount, loan amount divided by contract amount gives us 1. But this one suggests that we are hedging 3 months period. We are hedging 3 months period. Loan amount divided by contract amount. Loan amount divided by contract amount, 100 over 100 gives us 1. 1 suggests that we are just hedging $100 and a 3 months period. But how many 3 month periods do we have? Is given by loan period over contract period. We need to hedge two 3 month periods. 6 over 3 gives us 2. 2 suggests we need to hedge two 3 month periods. Agreed? So loan amount over contract amount, loan amount over contract amount, loan amount over contract amount gives us the number of contracts we need to hedge the amount over a 3 month period. Loan period over contract period tells us how many 3 month portions you need to hedge. Is it clear? For some of you, it might be boring because you already know this concept, but this class is going to refresh all your concepts. Is this clear? Mavila, clear? Okay. One last example. What if loan is 100, contract size is 50, loan period is 6 months and contract period is 3 months. Now your loan amount is 100 Now your loan amount is 100. Okay, your loan amount is 100. How many contracts will you need? 4 contracts. Okay, loan amount is 100 divided by the contract amount, which is 50. It gives us 2. It tells us that you need 2 contracts. Okay, but do remember that one contract of 50 is going to hedge how many months? One contract of 50 is going to hedge how many months? One contract of 50 is going to hedge 3 months. It is not going to hedge 6 months. So if I just do 100 over 50, it means that only 3-month period will be hedged. It means that only 3 months period will be hedged. Are you able to understand what I am saying? Like for example, this is 1, 2, 3. The first 50 hedged the first 3 periods, and the second 50 hedged the first period, 3 periods as well. Okay, but I have to be also careful that my loan period is not 3 months. My loan period is 6 months, which means that I have to hedge the next 3 months for 50-50 as well. Okay, is it clear, everyone? Can we proceed? Quickly. If any single student has any doubt, please talk to me. Excellent. Okay. Now over here, how many contracts will we go for? Loan amount is 36 million. Loan amount is 36 million. Contract size is 500,000. So 36 million divided by 500,000 tells us that we need 72 contracts. 36 million divided by 500,000. 36 million divided by 500,000. 36 million divided by 500,000 gives us 72 contracts. But do remember that these 72 contracts sufficient? No, they are only going to hedge 3 months period. Your loan is for 4 months. So you need to multiply it with 4 over 3 as well. So the contracts are going to be 96 contracts. Is it clear, everyone? Excellent. Okay, now what are futures, interest rate futures? What are interest rate futures? What are interest rate futures? Are they some tradable product? Can you think of them as some tradable product? What are interest rate futures? Can you think of them as some tradable product? Yes or no? Yes, they are tradable products. So you can sell them and buy later, or buy them and sell later. Okay. They are traded derivative products, and there are two things: sell now, buy later, and buy now, sell later. And there is one property which you need to remember, that if interest rates if interest rates increase if interest rates increase, you have to remember that they are inversely related, so the future prices will decrease. Do remember that if interest rates increase, the future prices decrease. If interest rates increase, the futures prices decrease. This is one very important thing that you need to remember. So they are inversely related to interest rate futures. They are inversely related to interest rates actually. Okay. Now, you can have two things. One is known as buy now, sell later, and the other is sell now, buy later. Okay, one thing is sell now, buy later, and the other thing is buy now, sell later. B and SL, buy now, sell later. SNBL, sell now, buy later. Okay. Have you heard about the terms short, and going long? What does going short and going long mean? If anyone can tell me, what do we mean by going short in futures market and going long in futures market? What does short mean? Going short. Shall I explain? Okay, what is short? What is short? You know or you don't know? In the futures market, there are two terms, short and long. What does short mean? What does short? If someone says go short in the futures market, short means sell now, buy later. Long means buy now, sell later. Okay? Short means sell now, buy later. Short means sell now, buy later. Okay, short means sell now, buy later. So if someone says go short in the futures market, it means sell now, buy later. Okay, all right. Now, first let's decide which futures will we go for. Will we go for December, March, or June? Will we go for, we have three options, December, March, and June. Which futures will we trade for? Which futures will we trade for? December, March, or June, and with reason? We go for first immediate future after loan start date. Okay. And what does March denote? What does March denote? That this future product is going to end in March. Okay. So if you have sold before March, you have to buy before March as well. Or if you have bought today, so you have to sell before March as well. This 93.95, you can think of futures as a product. You can think of futures as a product. And what does 93.95 represent? 93.95 represents the value or the worth of this future today. March futures are valued at 93.95 today. March futures are valued at 93.95 today. And what is today? What is today? Which date is today? As per the question, what is the date today? As per the question, what is 1st November? Okay. So this 93.95, this 93.95 is the value of March futures today. This 93.95 is the value of the March futures today. This 93.95 is the value of the March futures today. This 93.95 is the value of the March future today. Today means 1st of November. You can think of futures as a product and this is its value on 1st of November. You can think of futures as a product and this is its value on 1st of November. So this is the value of the futures on 1st of November. Is it good, everyone? Is it good, everyone? 93.95 is the value of the March futures today. Okay. Why we go for March? Because we have to hedge on transaction date. So we go for the first immediate futures right after the transaction date. What is our transaction date? When is the loan starting? Loan starts on 1st Feb. Loan starts on 1st Feb. Loan starts on 1st Feb. Or 31st of January. So the very first future products that you have are the March futures. Yes or no? Yes or no? Is this clear? Is this clear? Someone who asked me the question, we need to find the. Okay. All right. Now go for first immediate futures after the loan start date. Loan is starting on 31st of January. We will go for the March futures. March futures value is 93.95. March futures value is 93.95. So we will go for the March futures. Okay, now hedge strategy. What will be the hedge strategy? For that you need to know whether the case is of borrowing or deposit. Right now the question we are doing is borrowing, correct? In borrowing, what are we worried about? In borrowing, what are we worried about? In borrowing, what are we worried about? In borrowing, we are worried about that interest rates will go up. Correct? We are worried that interest rate, we are worried that interest rates will, we are worried that interest rates will increase. And we know that if interest rates will increase, what will decrease? We know that if interest rates will increase, what will decrease? Future price will decrease. Because they are inversely related. Inversely related. So can I say that in case of borrowing, I expect this 93.95. If the interest rates go up, if the interest rates go up, if the interest rates go up, I expect this price to decrease or increase. I have, it is a case of borrowing. In case of borrowing, I am worried about the interest rates being increasing. If interest rates increase, future prices will decrease. If interest rates increase, future prices will decrease. So I expect that if interest rates will increase, the future prices are going to decrease and they are going to be less than 93.95. Okay. So which strategy is better? Buy now, sell later or sell now, buy later? Which is better? Buy now, sell later or sell now, buy later? What shall I do? Sell now, buy later. Sell now, buy later. Sell now, buy later is the better strategy because this specific product today its value is 93.95. I know that after some time it is going to be cheaper. So isn't it better to sell at a higher price, buy at a lower price? Sell at a higher price, buy at a lower price. Sell at a higher price, buy at a lower price. Do you all agree? It is sell now, buy later. So are we going short or long? Short or long? We are going short. Okay, we are going short. We will say that we are going short. Sell now, buy later. Sell now, buy later. Okay, so we are going short. Now, my strategy in case of borrowing. In case of borrowing, what is my strategy? My strategy is sell now, buy later. Or in other words, we call it going short as well. Okay. Okay, let me explain again. Do remember this specific fact that if interest rates increase, future prices will decrease. Agreed? If interest rates increase, future prices will decrease. Do you understand this? Yes or no? Mavila, please confirm me. Do you understand that if interest rates increase, future prices will decrease? This is the first thing that you must remember. Okay. Second thing, we are doing a borrowing case. We are doing a case of borrowing. In case of borrowing, what are we worried with? In case of borrowing, are we worried with interest rates increasing or are we worried with interest rates decreasing, going up or increasing? So we know that if interest rates go up, what will go down? We know that if interest rates will go up, the future prices are going to Mavila. Are you here? It was your query. Everyone is answering. I'm waiting for your answer. We know that future prices will reduce. So isn't it better to sell futures today at a higher price and later on buy them at a lower price? Correct? Sell now, buy later is going to give us a gain. We will sell today at higher price and buy them later at a lower price. So we can say that in case of borrowing, we are worried that interest rates will increase. We know that if interest rates will increase, future prices will decrease. So sell now, buy later is an appropriate strategy, or going short is the appropriate strategy. Can I say that in case of deposit, if we do some question relevant to deposit, everything will be other way around? In case of deposit, what are we worried with? In case of deposit, what are we worried with? In case of deposit, we are worried that what if the interest rates will decrease? What if the interest rates will decrease? So if interest rates will decrease, what will happen? Future prices will increase. Future prices will increase. So what is the better strategy? I know that something is cheap today and it is going to be expensive later. So the best strategy is buy now, sell later, or in other words, going long in the futures market. Is this session helpful or is it a waste of time? I don't know. I am taking too much time, probably explaining all the basic concepts. Is it good? Okay, thank you. So do remember these rules. If you want to take picture or a screenshot, this is going to help you while solving the futures, both in case of borrowings and in deposits. In case of borrowing, we are worried that interest rates will increase, future prices will decrease. So SNBL. In case of deposit, interest rates will decrease. This is our worry. This is our concern. So we know that future prices are going to increase. So BNSL is the better strategy. Okay. Now we know that we will go for March futures. Do remember that this is the rate of futures today. Do remember that this is the rate of futures today. So let's do futures over here, I believe. Futures. Okay. What is the date today? What is the date today? What is the date today? Today's date is 1st of November. Okay. When are what is your transaction date? 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 It is 31st of January. Okay. Transaction date means the date at which we will either deposit or borrow. And what is the futures closing date? What is the futures closing date or the last date? Futures closing date. Do remember that futures close out at the end of each month. Do remember that the futures close out at the end of each month. Close out 31st of March. Always remember that you will need these three dates. Always remember that you will need these three dates. Okay. Today, transaction date and close out date. Okay. Now, what will you do today? What will you do today? Will you buy, sell something? Will you do something today? What are you going to do today? Are you going to sell futures today? Correct. So over here, let's do the future workings below instead. Today, the first thing that I will do today is sell futures. Okay. We have decided the strategy. So today we will sell the futures. And what will we do on transaction date? On transaction date, we are going to buy futures. Okay. Now selling today and buying later will give me gain. Correct. Selling today and buying later will give me gain. Correct. Okay. Now at what rate am I going to sell the futures today? At what rate am I going to sell the futures today? I am going to sell the futures today at 93.95. Correct? Okay, on transaction date, will I do something else? Buying the future is one thing. It was a hedging technique. Buying futures was one thing, but will we do anything else on transaction date as well? Yes, we will do the borrowing. We will borrow the loan. This was our main purpose. Okay. Definitely we will do two things. Number one, on 31st of January, we will borrow the loan. And number two, we will close the futures position. We sold futures earlier, so we need to buy the futures to close the futures deal. Is it clear? Is this clear? Okay, on transaction date, if I will borrow, as per the question, if you go back to the question, we were worried that the rates will increase to 6.6%. So my borrowing cost will be 6.6% plus 0.4% multiplied by 36 million multiplied by 4 over 12. Agreed? So what is this amount? This is 840,000 as in the previous case. Correct? No difference over here. Now this original borrowing is not linked with your hedging. Okay, like it is not directly linked. But what will actually happen that selling futures at a higher rate and buying them at a lower rate is going to give you gain. Actually, SNBL, sell now, buy later, is going to give you a gain on derivatives market, futures market, and the gain is effectively going to reduce your overall cost. Okay, sell now, buy later, sell now, buy later is actually going to give you a gain on futures or the derivative market, which will reduce your overall cost. Is everything clear at this point, till this point? Okay, now let's go to today. You will make three columns. You will make three columns. Number one, interest rate. Number two, futures price. Number three, basis. Are you all familiar with this type of table? I make this type of table which makes my life very easy. You have today, transaction date, closeout date. You have a column for interest rate and for the futures price and then basis. Is this clear to everyone? Any confusions, please speak out. You all have to pass the exam. I have already passed it long ago. It is your time. So if you have any confusions, please ask. Please don't be silent. Please don't be silent. Till this point, is it clear? Now I'm going to fill the table, obviously. Okay. All right. Now, what is the futures price? What is the futures price? The futures price today is 93.95. Okay. This is the first value out of the 6 values. Is it clear, everyone? Okay. What is the purpose to make this table? What is the purpose of making this table? What is the purpose of making this table? The purpose of making this table is to predict the value or predict the futures price on 31st of January. Obviously, what will happen on 31st January, I cannot say with certainty. This table helps me to calculate the expected. This table helps me to calculate the expected. This table helps me to calculate it expected futures price on 31st January. Okay. This table helps me to calculate the expected futures price on 31st of January. Okay. All right. Now, how do I write interest rate today? What was the interest rate today? As per the question, interest rate today is 5.7. As per the question, interest rate today is 5.7. As per the question, interest rate today is 5.7. And you are worried that it is going to increase to 6.6. You are worried that it is going to increase to 6.6. Do note one important thing, that we will not count this 40 basis points. The table is prepared on base rate basis. The table is prepared on base rate basis. You will use the base rates. You will use the interest rate. Which interest rate? Only the base rate. You will only use the base rate. So what is base rate today? Base rate today, the base rate today is 5.7, which can also be written as 100 minus 5.7. So what is 100 minus 5.7? 100 minus 5.7 is 94.3. So this is going to be 94.3. Okay. And what is the difference between interest rate today and futures price today? It is 94.3 minus 93.95. That is 0.35. Basis is the difference between the two. Please ask me if there is any problem. This is very, very important. Is this clear, everyone? Today's interest rate is 5.7, which can be reflected as 100 minus 5.7, that is 94.3. And the future price today is 93.95, that we also know. So, can you explain? Okay, interest rate can either be written as 5.7% or 100 minus interest rate. If you have to write interest rate in terms of futures value, 100 minus interest rate. This is the technique. So interest rate today was 5.7. It can also be written as 94.3. Okay. And basis is the difference between the two, which is 0.35. Now, if we go back to the question, there is one very important line written over here. Assume futures and option contracts are settled at the end of each month. Basis is assumed to diminish to 0. at contract maturity at a constant rate based on monthly time intervals. This is important. Basis is assumed, which means that in reality, this may happen or this may not happen. Basis is assumed to diminish to zero, which means that the basis, which is the difference between the interest rate and the future rate, will become zero at contract maturity. Contract maturity means closeout date at a constant rate based on monthly time intervals. Okay, so this actually means that over here basis will be zero. At this point basis will be zero, and basis is difference between the interest rate and the futures price. This means that at closeout rate both will be same. We don't know the values, maybe 95, 95, 94, 94, 96, 96, 97.95, 97.5, but both will be same because there will be no difference. Is this clear? Is this clear? Now, the question stated that basis will be zero at contract maturity. Okay. And they also said that the basis is going to reduce linearly every month. So basis on 1st November, basis on 1st November is 0.35, correct? And it will become zero in how many months? 0.35 will become zero. 0.35 will become zero. 0.35 will become zero in how many months? November, December, January, Feb, March. 0.35 will become 0. 0.35 will become 0 in 5 months. And every month, the reduction is going to be linear. Every month, it is going to reduce linearly. So what is the monthly reduction? Monthly reduction. 0.35 will become 0. So it will reduce 0.35. If it is becoming 0, it is reducing by 0.35 over a 5 months period. So every month it is decreasing by 0.07. Yes or no? Yes or no? So 1st November basis is 0.35. On 1st December, it will be 0.28. On 1st of January, it will be 0.21. On 1st of Feb, it will be 0.14. On 1st of March, it will be 0.07. On 1st of April, it is going to be 0.00. 1st of April technically means 31st of March. So what will be the amount of basis on 31st of January? 0.14. So now we know this value as well. Do you all understand? 0.35, 0.28, 0.21, 0.14, 0.07 and 0.00. Now, there has been a past paper in which they gave you basis on transaction date. It is a very old past paper. Okay. Over here, the information given to us was that the basis will reduce linearly. So we calculated the expected basis on 31st of January. But there has been a past paper in which basis on transaction date is given. For example, what if the question says that basis on transaction date will be 0.16, 0.17? Okay, so in that case, you will use that particular basis. But right now we have calculated basis. Is this clear, everyone? Okay. So in this question, it was mentioned that the basis is going to reduce linearly and will become zero on contract maturity. So we calculated the monthly decrease, but maybe in your attempt, they say that the basis on transaction date is going to be 0.2. Okay. I said that in one of very old past papers, they gave you basis on transaction date. For example, what if they say that this value is 0.16? So you will use that. What if they say that this value is 0.17? So you will use that. So although over here this was not the case, we were given information that they are going to decrease linearly, but you have to be very careful. Okay. Now if interest rates will increase, if the base rate is going to increase to 6.6, so it will be 100 minus 6.6. It is going to be lock-in rate we use in currency hedging. 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 100 minus 6.6 is 93.4. Correct? Now, can you calculate the futures price? Can you calculate the futures price? Can you calculate the futures price on the transaction date? Is it 93.26, everyone? Will we add 0.14 or will we subtract 0.14? We know that if this is A and if this is B, so C was calculated as A minus B. Okay? Okay. Maria, let me explain you today. How did you calculate this 0.34, 0.35? If I say that this is A and this is B, C was calculated as A minus B, yes or no? So can I say that over here as well, if this is A, this is B, this is C, so we know that C is A minus B. So if C is A minus B, if B comes to the left hand side, it will be C minus B, C plus B is equals to A, and B will be A minus C. Correct? So it is going to be 93.26. Okay? Okay, don't mix currency hedging with this topic. Currency hedging is very, 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 very different from interest rate hedging. Right now, let's don't mix those two together. Let's focus and complete the interest rate hedging first. Yes, someone can maybe calculate basis as 93.95 minus 94.3, but no, it cannot be zero. Generally, basis is a positive number. So it is ideal, or it is better that you subtract the larger value from the smaller value. Okay? Is this clear, everyone? Okay. Now, what will we do? Our final answer will be that we sell now at 93.95 and buy later at 93.26. So on futures trading, what is happening? We sell now at 93.95, buy later at 93.26, These values are in percentage. These values are in percentage. Okay, these values are in percentage. 93.95 and 93.26 both are in percentage. 93.95 and 93.26 both are in percentage. So in order to convert them into numbers, we divide by 100. Okay, multiplied by how many contracts? 96 contracts, each of 500,000. 96 contracts, each contract of 500,000. And what was the duration of each contract? What was the duration of each contract? What was the duration of each contract? Duration of each contract was 3. So 3 over 12. Now do remember, some students, what mistake they do is that instead of taking the contract period, they take the loan period. Do remember that you have to take the contract period over here and loan period over here. Okay, don't say 4 over 12, it will be 3 over 12. This was your contract period. But sir, the loan was for 4 months. The impact of one less month is already adjusted at this place. The impact of one less month is already adjusted at this place. Agreed? We increase the number of contracts. Because the contract period was 3 months instead of 4 months, we have already incorporated the impact of that in the number of contracts. So now 93.95 minus 93.26 divided by 100 multiplied by 96 multiplied by 500,000 multiplied by 3 over 12 gives you a gain of 82,800. So your net cost is 840,000 minus 82,800, which is 757,200. This is your net borrowing cost. Okay. Again, since this net borrowing cost is for a 4 months period, if you want to calculate effective cost, 757,200 divided by 4 multiplied by 12 will give you annual cost divided by 36 million. So what is your effective cost? 6.31%. This is your futures. Any confusions in futures? Any confusions now? Any confusions now? Now do remember that when we talk about futures, what we do today was 1st of November. On 1st of November, you either sell or buy future. That's it. This is the one thing that you do. Okay. And what do you do on transaction date? In our question, transaction date was 31st of January. On 31st of January, you close the deal. If you have sold previously, you buy now. If you have bought previously, you sell now, and you borrow the loan or you make the deposit. So one action today and two actions on the transaction date. Is there an Excel file where this question is solved properly? Yes, I have solved it in September 2023 live classes as well. Can someone please confirm me? Was it solved in September 2023 live classes? I believe it was. Okay. Now, one more part is remaining. One more part is remaining, and the next part is about options. Okay, this is the next part. This is about options. The 82 is what if we want to title it. This is gain on future trading. This is gain on futures trading. This is gain on future trading. I am not getting 6.31. Okay. Step number 1. Tell me what is 757,200 divided by 4. What is 757,200 divided by 4? Tell me what is 757 divided by 4. 757 200 divided by 4. 189,300. Good. Now multiply it with 12. Now multiply it with 12. Now multiply it with 12. What is it? 2271. 2271600. Correct. Now divide this with 36,000,000. That is 36 million. Be careful while putting number of zeros. Okay. All right. So I hope that everyone is clear till now. Okay. Now options on 3-month dollar futures. Options on 3-month dollar futures. Contract size is same. So we don't need to calculate the number of contracts again. If contract size is same, we don't need to calculate the number of contracts again. Correct? Correct? Okay. Now, let's do this options. Are you all ready? Are you all ready for the options? Okay. Now, strike price is 93.75. Strike price is 93.75. Okay. And over here we have a word which says call. Over here there is a word which says put. If these are options on 3-month dollar futures, which calculation did you not understand? Did you go somewhere and come back after 10 minutes? A last question, if you can repeat for 5 seconds. Which calculation, Ramesh? This 840,000, this 82,800, this 750. Okay. Ramesh, you sold the futures at 93.95, correct? You sold futures at 93.95, yes or no? Okay. And later you bought them at 93.26, yes or no? So 93.95 minus 93.26. How much is 93.95 minus 93.26? How much is 93.95 minus 93.26? Is it 0.69? Is it 0.69? Quickly, Ramesh. Now, this is a gain on trading, correct? This is a gain on trading. Gain is 0.69, correct? Because you sold at a higher value, bought at a lower value. Okay, now it is clear. Okay, excellent. Now let's go back to the options. Now, what does the call option mean? Tell me, what does call option mean? Call option mean option to buy. Option to buy what? Option to buy what? Call option means option to buy, but option to buy what? Underlying asset. What is the underlying asset over here? Futures. What is the underlying asset over here? Futures. At what date? At what date? Option to buy futures at the date mentioned over here. So for example, if I go for March, it means 31st of March or any day before that. Okay. There are actually 3 different categories of options: American options, European options, Bermudian options. But don't worry about that. Right now, just think that if you go for a call option, and if it is a March call option, it means that if you want, you can buy futures. You can buy futures at 93.75. You can buy futures. Future is a product. Future is an underlying asset. If you want, you can buy futures at 93.75 whenever you want before 31st of March. What does call option mean? Call option means, oh sorry, put option means option to sell. Put option means option to sell. What is the underlying product over here? Underlying product over here is futures. So if I go for March put options, it means that I have an option to sell futures. Future is an underlying product. Future is anything that I have. I can sell futures at 93.75, which is my strike price. Is it clear? Now first let's select the month. Which month will we go for? Will we go for December? Will we go for March, or will we go for June? Will we go for December, March or June? Will we go for December, March or June? We will go for March. Why March? We select the first option, we select the very first option available, right after the transaction date. My transaction date is 31st of January. My transaction date is 31st of January. So the very first options available to us are March options. Correct? So we will go for March option. Is it clear? Now, this is a borrowing case, correct? Look over here. What is it? It is a case of borrowing. In case of borrowing, what are we worried with? In case of borrowing, what are we worried? In case of borrowing, we are worried that interest rates will increase. Correct? So if interest rates will increase, what will happen? If interest rates will increase, future prices will, if interest rates will increase, future prices will, decrease. Okay? In case of borrowing, we are worried that interest rates will increase, and if interest rates will increase, we expect that the future prices will decrease. And this is what is evident from this table as well. Future prices today are 93.95. 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 And expected future price on transaction date is 93.26. Expected future price on date of transaction is 93.26, which means it will go down. And it is evident from this prediction as well. This is a prediction, but the prediction also says that if the future prices are 93.95 today, they are going to decrease and become 93.26 on transaction date. Correct? If the future price is 93.95 today, we expect it to reduce and go to 93.26 on transaction date if the interest rates increase. Correct? Now this 93.26 is the rate of futures on which date? This 93.26 is the expected futures rate on the date of transaction, that is 31st of January. Now what I do in case of borrowing, if I have options, I go for put options. Okay, why put options? Why will I go for put options in borrowing case? Why will I go for put options in borrowing case? In any borrowing question, we go for put options. Why will we go for put options? Indira and Srinidhi, absolutely incorrect. In case of options, you do not do anything today. Do remember that in case of option contracts, you don't do sell now, buy later, you don't do buy now, sell later. You don't do anything right now. We go for put option. What does put option mean? Put option means option to sell. What does put option mean? Put option means option to sell something. What does put option mean? Put option means option to sell something. And what is the strike price? What is the strike price? What is the strike or exercise price? Strike or exercise price is 93.75. Strike or exercise price is 93.75. What is the strike or exercise price? 93.75. Listen carefully. If I buy put options today, 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 it will give me a right to sell future contracts at 93.75 on transaction date. If I buy future, if I buy put options today, if I buy put options today, it will give me a right to sell futures at 93.75 on transaction date. Why am I going for put options and not call options? I know that if interest rates will increase, the value of, let's say this is a future, the value of futures is going to decrease. So in the open market, this calculator will be available at a cheaper rate or a higher rate. In the open market, this calculator will be available at a cheaper rate or a cheaper rate. So I will go to the open market and buy at a cheaper rate. I will go to the open market and buy this at a cheaper rate. I will go to the open market and buy it at a cheaper rate. And then I will put, put means sell, exercising my option, I will sell. So I will buy from the open market at a cheaper rate and sell it at a higher rate using my put option. I will buy from the open market at a cheaper rate. Open market is for everyone. So I will buy from the open market at a cheaper rate and then put, sell, sell at a higher rate. How can I sell at a higher rate? Because I have bought options today. Now, in case of options, listen carefully. In case of options, what will you do today? What will you do today? Today means on 1st of November. Today we will do only one thing, that is we will pay premium. Today we will do only one thing, that is we will pay premium. That's it. Okay? In case of borrowing, we don't buy any futures today. We don't sell any futures today. In case of options, it is not buy now, sell later. It is not sell now, buy later. We do not buy calculators today. Are you able to differentiate futures and options? In case of futures, what do we do? In case of futures, do we sell now or buy now? Yes or no? We just did a futures exercise over here. Over here, I said that today sell now, buy later. But in case of option contracts, do we buy the futures today for selling them later? No, we do nothing. We buy options. We buy put options. And consideration for buying of put options is the only premium charge. So today we pay premium. We will buy the put options. And then what will happen? On transaction date, what will happen? On transaction date, there will be original loan. Okay, original loan at its place. And what else will we do? What else will we do? We will have the right but not an obligation to sell something. And as per this question, we can, if we are going for put options, we will be able to sell something at 93.75. Okay. So for example, I know that if I have this calculator, I can sell it at 93.75. I have put options. Put option means that I can sell this for 93.75. Yes, it will be. Okay, so I know that for a put option, I know that if I want, I can sell it at 93.75. I know that if I want, I can sell this calculated at 93.75. Now, will I exercise my option or not? I will see what is the market value of this calculator. If the market value is less than 93.75, if the market value is less than 93.75, it means that I will buy at a lower price and sell it at a higher price. Understood? Okay. So we can say that in any question which is about borrowing, we go for put options. And in case of deposits, what do we do? In case of deposits, again, there is a logic, but in case of deposits, we will go for call options. Again, for complete logic, we will do a separate thing. Okay, let's now do the working. Let me erase this area. I believe this is the easiest area. You can also look from ACCA answer for it. Okay, now today, how many option contracts? Everything is same. If the terms are same, there will be 96 contracts as well, because these option contracts are for 3 months as well. Contract size is 500,000 as well. Okay. And the premium, option premiums are in annual percentage. Option premiums are in annual percentage. So if we are going for March put options, this 0.087 is 0.087%. This 0.087 is 0.087%. Do you understand? This is 0.087%. This is 0.087%. So today we pay premium. It is 96 contracts, each of 500,000, and time duration is 3/12, and premium is 0.087%. Tell me, what premium do we pay today? 10,440. Correct? This is the only thing that will happen today in case of options. This is the only thing that will happen today in case of options. Now, transaction date. Transaction date. Original loan, same working. So I am writing it directly, 840,000. Okay, payment of premium is a cost. 840,000 is also a cost. In fact, let me write cost without bracket. Original loan borrowing cost, is this correct? Okay. Furthermore, what will happen? Strike price or exercise price is how much? Strike or exercise price is 93.75. And the expected value of futures on the same date is 93.26. Will we exercise it? Yes or no? If I can buy something at 93.26 from the open market and sell the same thing at 93.75, will I exercise my option? Yes or no? Definitely I will exercise my option, because exercising the option is going to give me a gain. Correct? Exercising the option is going to give me a gain. Correct? I will buy the futures from open market. Open market is for everyone. And I will put them or sell them same day at 93.75. Now do remember that buying and selling is taking place on same date. Do remember. Okay, exercise price or a strike price is the value at which you can sell something, correct? So if something is available in open market at 93.26 and you can sell it at 93.75, will you exercise your option? Will you put that product? Will you exercise the option? Exercise price given was, we will exercise the option. We will not exercise the option. Listen, if you can buy this calculator for 93.26 and sell it at 93.75, is it beneficial or not? If I can buy this at 93.26 and I can sell it at 93.75, I will be able to make a gain. So I will exercise the option. I will definitely exercise the option. So now do remember the difference. This buying and selling in case of option happens on same day. In case of future, it was different. Yes. So my gain on options will be 93.75 minus 93.26 divided by 100 multiplied by 96 multiplied by 500,000 multiplied by 3 over 12. $58,800. This is a gain. Gain reduces your cost. So your net cost is 10440. This is you paid. 840,000 you paid. And 58,800 you obtained. So 791,640. Okay. Over here in this specific scenario, are we exercising the option? Yes. Exercise the option. Why exercise the option? We are exercising the option because strike price or exercise price is 93.75 and the futures price is 93.26. How did we get 93.26? We did this specific working, the table. This is 93.26. How did we get 93.75? This is the strike price. Clear, everyone? Effective cost is divided by 4 into 12 divided by 36 million. Yes, 6.597, 6.6 or 6.59. Yes, 6.6% you can say. Is it clear, everyone? This is a payment, this is a cost, this is a payment, this is a cost, this is a receipt, this is a gain. Now ask me if there is any problem. Okay, over here my exercise price was 93.75, my futures price was, yes, we are selling at 93.75. We are selling at 93.75. We are selling at 93.75. Is it clear? Okay, those who are not enrolled, if you want free resources, you can WhatsApp me. You have my WhatsApp number. Let me mention it over here as well. Once again, WhatsApp me at +9715850689007. What if the premium is in cents? How do we treat it? Okay, premium is in cents in case of foreign currency hedging, not in case of interest rate hedging. In interest rate hedging, it is in percentage. The lower the cost, the better it is. Is it clear, everyone? Is everything till this point clear, everyone? Let's take a 5 minutes break. Let's take a 5 minutes break. During this break, I want you all to make sure that you have downloaded December 2021 past paper and its answer file and review the theory area. Review this question's theory area, and after break we will do one more question. Yes, net cost is our cost, correct? We paid premium, we paid interest cost, and we received this gain. Okay. One more thing, when will the option lapse? If, for example, in this case, my exercise price is lower than 93.26, I will let the option lapse. I hope you all have that concept with you as well, correct? So let's meet after 5 minutes break. Is the session slow or the speed is okay? And what is your feedback? Is it beneficial? We can probably do one more question online live relevant to hedging. Okay. So let's come back after probably 5-10 minutes, 5 minutes maybe. Quickly come back in 5 minutes so that we can continue and do one more question. Thank you. Okay, let's start. Is my voice audible? Is my voice audible, everyone? Let's start with the second question. And now we are going to do a case of deposit. Okay. This is Vardegul company. Again, you all will probably need the notings of today's session. Do you all have my WhatsApp number? Any public student, anyone? I hope you all have my WhatsApp number. If you don't have my WhatsApp number for free resources, you can WhatsApp me, and I will provide you all the resources including today's sheets as well. So let me write my number and then we are going to start with this second question. And if you need free resources, you can WhatsApp me. plus 971 58506 8907. Okay, can we start? This is December 2017. This is from December 2017. Okay, this specific question is from December 2017, and now we are solving this December 17 question number 4. Again, it is interest rate hedging and it is a case of deposit. Okay, please confirm if you are all are with me. Shall I start? Since time is limited, this time we need to be a bit quick. And since you have already done one question, I believe you will be able to do this one quickly with me. The question says, Vartical Company, a company based in the Eurozone, has expanded very rapidly over recent years by a combination of acquiring subsidiaries in foreign countries and setting up its own operations abroad. Vertical Companies Board has found it increasingly difficult to monitor its activities, and Vertical Companies Group support function, including its treasury function, have struggled to cope with a greatly increased workload. Vertical Companies Board has decided to restructure the company on a regional basis with regional boards and appropriate support functions. Managers in some of the larger countries in which Vertical operates are unhappy with reorganization on a regional basis and believes that operations in their countries should be given a large amount of autonomy and be supported by internal functions organized on a national basis. So this is probably relevant to your theoretical area, and again they are talking about treasury function. Again they are talking about centralization, decentralization, reorganization on a regional basis, things like that. Assume it is now 1st of October 2017. So the first relevant information today is 1st October 17. The Central Treasury function has just received information about a future transaction by a newly acquired subsidiary in Urea, where the local currency is the dinar. The subsidiary expects to receive 27 million on 31st of January 2018. It wants this money to be invested. It wants this money to be invested locally in Urea. Most probably for 5 months until 30th June 2018. Now, is this question about foreign currency hedging or interest rate hedging or both? Is this question about foreign currency hedging or interest rate hedging or both? This question is about interest rate hedging or foreign currency hedging or both. Do remember that the amount we received was in Urea. It was in dinars. Was it converted into parent company's currency before investment? Was it converted from dinars into parent company's currency before investment? Yes or no? Or was it invested locally in the same country? In this question, you received an amount. In this question, you received an amount in dinar and it was invested in dinars as well. So there was no currency exchange. Okay. Is there any past paper in which both foreign currency and interest rate hedging were tested together? Yes. There is one past paper, I cannot recall the exact name, but yes, there is one past paper in which foreign currency hedging and interest rate hedging both were tested together. For example, what if the question says that you will receive dinars from your subsidiary, and when you receive, you will invest them for a certain time period. Are you able to understand what I am saying? Over here, the investment currency and the currency in which you receive the amount are same, but they can be different. Okay? The amounts can be different. Are you able to understand what I am saying? There has been a past paper in which these amounts are different. Okay, I cannot actually recall the exact past paper, but yes, there has been a past paper in which you converted the foreign currency into local currency, and then you invested that particular currency. Over here, this is a simple case in which you have received the amount in dinar and you have invested the amount in dinar as well. So now it is today 1st of October. Okay. Then the second important date is that your amount is 27 million dinars. Amount is 27 million dinars. Then when are you investing? Deposit date or deposit start. Deposit start. Deposit start is 31st of January 18. What is deposit end? What is deposit end date? For 5 months until 30th June 18. Okay. All right. So now we are done with this paragraph. Okay, it says Vardigul Company's treasury team is aware that economic conditions in urea are currently uncertain. The central bank base rate in urea is currently 4.2% and the treasury team believes that it can invest funds in urea at the central bank base rate less 30 basis points. So central bank base rate minus 0.3% and central bank base rate right now is 4.2%. So 4.20% minus 0.3% gives you 3.9%. Okay. However, treasury staff have seen predictions that the central bank base rate could increase by up to 1.1% or fall by up to 0.6% between now and 31st of January. So two things can happen. Either it can increase, and it can increase by how much? Increase by up to 1.1%, which means that it can go to 5.30%, and it can also decrease by 0.6 and go to 3.60%. Both are possible. Okay. Do remember that the increase and the decrease is linked with the base rate. Okay. Always remember that the increase or decrease and the hedging portion is relevant to the base rate. It is not relevant for everything. It is relevant to the base rate only. Are we all together? IRA 3.6%. Where is 3.6%? No. Current base rate is 4.2. Current base rate is 4.2. Current base rate is 4.2. It can decrease by 0.6. It can decrease by 0.6. So if 4.2 decreases by 0.6, 4.2 can decrease by 0.6. So if 4.2 can decrease by 0.6, it can become 3.6%. Or otherwise, if 4.2 in other case can also increase by 1.1%, If it increases by 1.1%, it can become 5.30%. Both cases are possible. Okay. Vertical companies treasury staff normally hedges interest rate exposure by using whichever of the following products is most appropriate. FRA or forward rate agreement, interest rate futures, options on interest rate futures. Okay, now FRA. Today is 1st of October. Deposit start is how many months away from today? Deposit start is how many months away from today? Today is 1st of October. You will deposit on 31st of January. Today is 1st of October. You will deposit on 31st of January, which means you will deposit 4 months from today. You will deposit for 5 months, which means that your deposit will end 9 months from today. So which will be the relevant FRA? Which will be the relevant FRA? Which will be the relevant FRA 4-9? Okay. Was it easier this time? FRA is identified as start and end date from today. So the deposit starts 4 months from today. Deposit ends 9 months from today. So FRA will be 4-9. Okay. October to January is 4 months. October to June is 9 months. Okay. Interest rate futures. Interest rate futures. Okay. Now, if someone is watching this video in recorded format, I have just solved a very detailed question. I have just solved a borrowing case in very detail, and it is in continuation. So that's why we are slightly paced up. Now let's discuss deposit. In case of deposits, what are you worried with? In case of deposits, what are you worried? That interest rates will decrease, because a decrease in interest rate will mean less income. If interest rates will decrease, future price will. If interest rates will increase, future prices will increase. If interest rates will decrease, future prices will increase. So what will you do? Buy now, sell later, or sell now, buy later? What will you do? Buy now, sell later. Buy now, sell later. Why? Because right now futures are at a cheaper rate. Right now futures are at a cheaper rate. So you will buy now at a cheaper rate and sell later at a higher rate. Correct? So now this is buy now, sell later. Buy now, sell later. Do you feel more comfortable now? How do you tell this is a deposit rate? Because we were receiving this amount. We were receiving this amount. We wanted to invest this amount. Written in the question. Mentioned in the question. We were receiving this amount. We wanted to invest this amount. So the strategy is very easy. Buy now, sell later. Okay. Why buy now? Because right now the futures are not very expensive and they are going to become expensive later. So I will sell them at a higher price later. Buy now, sell later is the strategy, and it is a deposit case. It is a case of investment. Okay. All right. Now in case of options, we are in continuation. We just did a borrowing case. In case of borrowing, which options did we select? Call or put? We just did a question based on borrowings. We just did a question on borrowings in which we selected put. In case of borrowings, we selected put. Now, in case of deposit, what will we select? Call. Excellent. Why call? Why call? Why call? Logic, 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 logic. Call means option to buy. Call means option to buy. I know that future is a product. Where is my calculator? Where is my calculator? Okay. This is a future, correct? I know that it will become it will become expensive. It will become expensive. So what will I do? Call it a lower price, call it a lower price, exercising my option, and sell it in the open market at a high. No, it is not buy now, sell later. It is not buy now, sell later. It is not buy now, sell later. Helen, please. It is not buy now, sell later. In case of options, we do not purchase any product today. In case of options, we wait till the transaction date and do comparison with the exercise price. Okay. So things are becoming easier now, but I don't want you to memorize things. I want you to conceptually understand why we are doing something. Anyways, so we know that for options, we will go for call options. Excellent. All right. Treasury function guidelines emphasize the importance of mitigating the impact of adverse movements in interest rates. However, they also allow staff to take into consideration upside risk associated with interest rate exposure when deciding which instrument to use. Okay, for this specific question, have you all downloaded an Excel file? I have broken down this question into simpler parts. Do you have that particular file with you? Do you have that particular file, Excel file with you? I have broken down this specific question into very simple parts. I will share that file with you as well. It is in the Google Drive as well. If you go to past paper and relevant material folder, and if you go to December 2017 folder. Okay. Anyways, I have also mentioned my number. Okay, moving on. A local bank in Urea with which Vertical has not dealt before has offered the following FRA rates. Now tell me, is it 5-10 or 4-9? 4-9. Excellent. Excellent. Okay. Let's read the requirements first before proceeding. Part A recommend a hedging strategy for the 27 million investment, which means deposit. Based on the hedging choices which treasury staffs are considering, if interest rate increases by 1.1% or decrease by 0.6%. So we have to do two things every time. Case 1, case 2. Support your answer with appropriate calculations and discussion, 18 marks. Discuss the advantages of operating treasury activities through regional treasury functions compared with each country having a separate treasury function, operating activities through a single global treasury function. Again, you have to write centralization, decentralization, advantages, disadvantages of treasury function molded correctly. Now, this is a very detailed question. So let's start with FRA. In fact, let me solve FRA here. Okay. Now, FRA. What if the rates go up by 1.1%? What if the rate go up by 1.1%? Do remember that in this question we have two cases. Case number 1 is that what will happen if the rates go up, and case number 2 is what if the rate goes down. Now, if the rate goes up by 1.1%, what will be my deposit rate? What will be my deposit rate? My deposit rate will become 4.2% plus 1.1%, because if the base rate goes up by 1.1%, it will become 5.3%. And my deposit rate is how much? My deposit rate is 30 basis points less than this base rate. So 4.2% plus 1.1% minus 0.3% multiplied by 27 million multiplied by number of months. What is the number of months? 5 months. So 5 over 12. What is the answer? 4.2 plus 1.1 is 5.3 minus 0.3 is 5. 5% into 27 million into 5 over 12 is 562 500. Will I get this amount? Yes, 562 500. This is my original investment, correct? Now, if the rate goes up, what will happen? If the rate goes up, what will happen? If the rate goes up, what will happen? Why 5%? Okay. Current base rate is 4.2%. Current base rate is 4.2%. Agreed? Current base rate is 4.2%. Agreed? If this base rate goes up by 1.1%, if base rate goes up by 1.1%, it will be 4.2 plus 1.1, 4.2 plus 1.1. Okay. So 4.2 plus 1.1 is 5.3. 4.2 plus 1.1 is 5.3. 5.3 minus 0.3 because I can borrow at 30 basis points below. Correct? Is this clear, everyone? Now, if I have locked FRA at 5.02%, this means that my base rate has locked at this value. Are you all together? Are you all together? Okay, now what will happen with the FRA party? What will happen with the FRA bank? What will happen with the forward rate agreement bank? Will I pay them or will they pay me? Will I pay them or will they pay me, and how much? Will I pay them or will they pay me, and how much? Will I pay them or will they pay me, and how much? They will pay you. Why will they pay me? Listen, what is the prevailing base rate? What is the prevailing base rate? What is the prevailing base rate? We are doing the case in which base rate increases by 1.1%. Correct? So the base rate has moved to how much? The base rate has moved to 5.3%. The base rate has moved to 5.3%. Correct? Now, this is a case of deposit. 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 Correct? This is a case of deposit. And do remember that the comparison is for the base rate only. FRA party said that we are locking your base rate at 5.02%. FRA party said that we are locking your base rate at 5.02%. So in other words, FRA party is locking my overall rate at 5.02 less 30 basis points. Agreed? Now, if this is a deposit case, right now I am enjoying 5.3% return. But the FRA agreement says that the return rate must be 5.02%. So what will happen? Will I pay them or will they pay me? Please be very careful. They pay us. Why will they pay me? I am already enjoying higher returns. I will pay them. I will pay them because I have received higher return than what was decided. It was decided that the rate will be 5.02. But I am enjoying 5.3, so I am enjoying additional 0.28%. So I will pay them. 5.3% is what I am getting. As per the agreement, I must not get more than 5.02. 5.3 is what I am getting. As per the agreement, I must not get more than 5.02. So if I am getting additional return, I have to give it to the FRA party. So I will pay them 31,500. This is the case of deposit. So this is the return or receipts and this is the payment. So my net income is 531,000. My net income is 531,000. This is my net income. Now tell me what is my effective rate. 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 We have reduced the base rate when I calculated deposit. Hedging instruments work on base rate only. Hedging instruments work on base rates only. Hedging is on base rates only. If you even check the previous question, while we were comparing the FRA rate, we compared it with the base rate. Okay. Now, if I calculate my effective rate, it will be 5.02 minus 0.3, that is 4.72%. Okay, this is one way to calculate. 5.02 minus 0.3. Why minus 0.3? In case of deposit, the adjustment is reduced and it was also mentioned in the question. Or otherwise, how can I calculate? Other method is 531,000 is returned for 5 months. So you divide it with 5, multiply it with 12, and then this overall answer is divided by 27 million. So 531,000 divided by 5 into 12 divided by 27 million gives you 4.72%. Is this clear? Clear, everyone? Now this was one case. There are two cases in this question. Case number one was what will happen if the base rate increases. Case number two was what will happen if the base rate decreases. So now let's do the second case for FRA. Again, I am again doing FRA, okay? I am again doing FRA. Why am I doing FRA two times? Why am I doing FRA two times? In the last question that we did, okay, let me re-explain. Have you just joined us? Okay, what particularly do you did not understand? Do you understand this 562 500? Do you understand this 562 500? Tell me the value or tell me something where you are lost so that I can help you. And if anyone else needs any help, please talk. Where are you stuck? Please let me know so that I can help you. Hello. Am I audible? The last. What last? Name the last. Tell me what is last as per your understanding. Hello. What is last? What do you mean by last? Which value? Which working? Give me some hint. Okay. 4.72 is our effective rate. It can be calculated in two manner. Method number one is that we know that we have entered into an FRA of 5.02% and our deposit rate is base rate minus base rate minus base rate minus base rate minus 0.3. So this is 4.72. Do you understand this working? If I have entered into an FRA of 5.02%, it means my base rate will be 5.02%. You did not understand it. Have you been with us since inception, since the start? Do you understand what are FRA? Do you understand? Where point? Okay, this is the actually the question that I wanted to listen. It is mentioned in the question. Let me highlight it for you. Now you are on track. This is how you ask a question. Read this. It can invest funds in urea at the central bank base rate less 30 points. Can you see this? 30 basis points means 0.3%. 30 basis points means 0.3%. So if I have entered into an FRA of 5.02, so, and I can invest at base rate minus 30 basis points. So it will be 5.02 minus 0.3, that is 4.72%. Is it clear now? Is it clear now? Clear? So that's why my rate is 4.72%. This is my effective rate. Okay. Can I get 10, 20 confirmations to proceed further? Okay. Now, second case in the scenario was, what if the base rate decreases by 0.6? Everyone, now focus over here. Everyone, now focus over here. Second case was, what if the base rate decreases by 0.6? So if the base rate decreases, base rate currently is 4.2. Base rate currently is 4.2. Base rate right now is 4.2. If it decreases by 0.6, what will be the base rate? 4.2 minus 0.6. It will be 3.6. And I can invest at base rate less 30 basis points. I can invest at base rate less 30 basis points. So it will be, my deposit rate will be 4.2 minus 0.6 minus 0.3. 4.2 minus 0.6 minus 0.3. 4.2 minus 0.6 minus 0.3. Agreed? Agreed? Yes or no? My rate will be 4.2 minus 0.6 minus 0.3. Yes or no? Multiplied by amount of investment, that is 27 million, multiplied by 5 over 12. So what will be my deposit return? 4.2 minus 0.6 minus 0.3 is 3.3% into 27 million into 5 over 12. So what is the answer? 371250. Are we all together? Are we all together? Are we all together? Are we all together? If 4.2, the base rate decreases by 0.6, it will be 3.6. I can deposit at base rate minus 0.3, so it will be 3.3%. So this is what I am receiving. Okay. Now, I will compare 5.02% my FRA agreement rate with what rate? I will compare 5.02 with what percentage? I will compare 5.02 with what particular percentage? Base rate, that is 3.6. Agreed? I will compare it with 3.6. And I will tell the FRA party, that I am receiving less from my original deposit. So kindly compensate me the difference, which is 1.42%. Do you all agree? Do you all agree? Do you all agree? So the FRA party is going to give me a compensation of 1.42%. Again, 27 million into 5 over 12. So this time I am going to receive from the FRA party. This time I am going to receive from the FRA party 159,750. So what is the total amount that I am receiving? 371,250, 159,750. This is again 531,000. Okay. Rahman says, why for deposit question mentioning less basis points rather than 8 basis points if we less? And we'll receive. Okay, Rahman, this is what is central bank base rate? Rahman is asking why in case of deposits it is base rate less 30 basis points. So Rahman, my question will be what is the base rate? Base rate is actually, for example, let's say, Rahman, are you from Pakistan? Rahman, are you from Pakistan? Sri Lanka. Okay. For example, in Pakistan, base rate is Kaibor. What is base rate? Kaibor. What does Kaibor mean? Kaibor is Karachi, Karachi, inter bank offer rate. What is Kaibor? Karachi inter bank offer rate. Likewise, we have base rates for every country. We have LIBOR, London interbank offer rate. For example, if Kaibor is 10%, first let's understand what does this base rate means. This means the rate at which one bank can get funds from another bank. Let's assume, let's make things simple rather than open up a new Pandora box. For example, if I say that Kaibor is 10% or base rate is 10%, it means that one bank can borrow from another bank at 10%. Rahman, is it clear? It is decided by the government. Okay. Now, if a bank is giving loan, they give loan at K plus 2%, K plus 3%, K plus 1%. Effectively, this is their cost price. K or Kaibor is their cost price. Plus 2% means a margin that they are earning. Do you get it? For example, if bank A wants funds from bank B, they can borrow at 10% and they can give it to someone at 10 plus 2, that is 12%. So effectively, K or Kaibor is their cost. To a customer, they are giving the funds at K plus 2%. If someone borrows, if someone takes loan, the bank will say, okay, we will charge you Kaibor plus 2%, Kaibor plus 3%, Kaibor plus 1%. Is this clear, Rahman? Why we add in case of loans? Okay. Now come to the case of deposit. If I go to the bank and I tell bank that I want to deposit certain amount with you, they will say, okay, you can deposit with us at K minus 1%. Now, in case of deposits, why it is subtracted? Because, for example, if K or Kaibor is 10%, they will get from me at 9% and then they can give it to another bank at 10%. Okay. So I believe it was just to make things simple. Okay, Rahman, one more thing. Don't use direct message. Use message to everyone so that others can see your question as well. Was it helpful for, probably I don't know how many of you know about the base rates or not. Do you know about LIBOR, Kaibor, everything? Do you all have this knowledge? Okay, excellent. Okay, anyways, coming back. Now, can I say that FRA is done and dusted? FRA for this question is done and dusted. All good? Again, your effective rate will come out to be same. Always remember that FRA will give you the same effective rate. Always remember that FRA is going to give you the same effective rate. Can we go for futures? Can we start with futures? We use the term repo rate. Okay, in Namibia. Excellent. That's good. Addition to my knowledge. Thank you. Okay, let's move to futures. Now, we learned a term short and long. What was short and what was long? Short was sell now, buy later. We did this in case of borrowing. Long, what will be long? Long is buy now, sell later. This will apply in case of deposits. Now over here we will do long, that is buy now, sell later. Okay. Again, number of contracts. Now, can I pace up a bit? Things are repeating itself. So, deposit amount divided by contract amount, we all know this, correct? Multiplied by deposit period over contract period. Okay. Now, I am not explaining this again. We have done it in detail just now in the very same session. So, there will be 90 contracts. Does contract currency matter? In case of futures, do contract currency matter? Do contract currency matter? No. Because we are doing what? Because we are doing interest rate hedging. Correct? Contract currency matters in case of foreign currency hedging. Excellent. Okay. Again, for futures, we will make the same table. Okay. Will we go for December, March, or June futures? Which futures will we select? December, March, or June? What is the deposit start date? 31st January. So we will select the March. Excellent. Now again, we will make the same table. Today, transaction date, closing date, we will write interest rate, we will write futures price. Difference between the two is called basis. I am doing it slightly quickly just because we have just done a similar working. Now, what is the futures price today? If over here it is mentioned 94.78, it is today's future price. It is today's future price. It is today's future price, which means that we will write it over here 94.78. Do you all agree? Okay, what is the rate today? Rate right now, base rate right now. Do remember, we will look into base rate. What is the base rate right now? Base rate, Anshika, base rate. Always remember that hedging tools use base rate. Sir, please, what if the contract length is not specified in the question? It will always be specified. Contract length is not specified in case of currency hedging. Okay, base rate is 4.2. How can it be written? 100 minus 4.2. What is 100 minus 4.2? 100 minus 4.2 is 95.8. Difference between the two is known as basis. 95.8 minus 94.78. So this is 1.02. Okay. At the closing date, basis can be assumed to diminish to zero at contract maturity at a constant date based on monthly time intervals. It can also be assumed that there is no basis risk and there are no margin requirements. So these two values will be same and this will be 0. Clear till now? All good? Okay. Now, date today is 1st of October. So this is 1st of October. This is 31st of March. October, November, December, January, February, March. How many months? How many months? 6. So now, and what is the transaction date? What is the transaction date? 31st January. Okay. So we know that 1.02 will become 0 in 6 months. What is the monthly decrease? 0.17. So this means that on 1st October, basis is 1.02. 1.02 will become on 1st November, it will become 1.02 minus 0.17, 0.85. On 1st December, 0.68. On 1st January, 0.51. On 1st Feb, 0.34. 1st March, 0.17. 1st April, 0. Do you all understand this? Okay. Now, this value will be 0.34. Agreed? Now, there are two cases in this question. 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 Okay, can you repeat the 0.17? Okay, basis today is 1.02. Agreed? Basis today is 1.02. Agreed? Basis today, okay. And it will become 0. It will become 0 in how many months? Basis today is 1.02 and it will become 0 in how many months? 6 months. 1.02 will become 0 in 6 months. Yes or no? So, what is the monthly decrease? What is the monthly decrease? 1.02 will become 0 in 6 months. So, monthly it will decrease by 0.17. Yes or no? Correct? So now 1.02 will decrease and become 0.85, then 0.68, then 0.51, then 0.34, then 0.17, and then finally 0. Good? Good enough? Okay. Now in this question, we have to do everything 2 times. In this question, we have to do everything 2 times. So this table will be different. Now, if base rate increases by 1.1%, if base rate increases by 1.1%, it will become how much? 5.3. Correct? This is one possibility. This is one possibility. In this case, what will happen? In this case, sorry, not bank base. This is 0.34. 100 minus 5.3. What is 100 minus 5.3? 94.7. Now tell me what will be the expected future price? What will be the expected future price if base rate increases from 4.2 to 5.3? 94.36. Correct? 94.7 minus 0.34 is 94.36. Is this clear, everyone? Is this clear, everyone? This is expected future price. This is expected future price if base rates increase. This is expected future price if base rate increases. This is expected futures price if base rate increases. What was the second possibility? Second possibility was, what if the base rate decreases? So from 4.2 minus 0.6%, it becomes 3.6. If the base rate decreases and if the base rate becomes 3.6, what will happen? IR will be 100 minus 3.6, 96.4. FP we need to predict. Basis will again be 0.34. What will be the futures price in this second case? 96.06. How many of you feel improved after this session, after today's session, till now? Obviously, the session is going on. Do you all feel better now? Oh, good, 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 good. So these are the two possible cases. These are the two possible scenarios which we need to work out. We have calculated the expected futures price now. Now finally we can do the futures working. Okay. So now let's do the futures working. There are two cases. Let's do the case in which the base rate increases by 1.1%. In this case, what will happen? We will deposit at 5.3% minus 0.3%. Amount of deposit is 27 million. Deposit period is 12 months. So this is going to be 562,500. Agreed? And when will this take place? Transaction date. Will anything happen today? Will anything happen today? What will you do? Buy the futures or sell the futures? We will buy futures today. We will buy futures today at what value? 94.78. And sell them later or on transaction date at what value? Which value will we use? 94.36 or 96.06? 94.36. Excellent. So is it a gain or a loss? Is it a gain or a loss? If I'm buying something at 94.78 and later on if I'm selling it at 94.36, I am making a loss. I did hedging to make a gain. But instead of a gain, I am making a loss. Because my expectation, listen carefully, this was a case of deposit. My expectation was what? That interest rates will go down or go up. My expectation was that the interest rates will go down. But in reality, what happened? In reality over here, instead of 4.2 going down, it went up. Correct? You can see over here that the base rate was 4.2. Instead of the base rate reducing, it increased. So there was some additional gain inbuilt over here as well. Can we say that we have an additional gain here? Because I expected that 4.2 will reduce. Instead, 4.2 increased. So if 4.2 increased, in actual, my earnings were more than my expectations. Am I able to deliver what I want to say? My income is 560 to 500. This income is more than my expectation. I expected that the base rate will be less than 4.2. Instead of being less than 4.2, it increased to 5.3%, leading to an extra income, extra actual income. But since the futures market operates entirely opposite, you expected that you will make some gain over there to compensate your loss. You are making a loss. So the loss is 0.42. It is in percentages. So we divide by 100. We are going for how many contracts? 90. 90 contracts, 500,000 each into 3 over 12. So this is my loss as well. 47,250. And my final answer 562,500 minus this is an 515,250. Is it clear, everyone? Is this clear, everyone? Please show some participation. Calculate the effective income rate. What will be the effective income rate? Effective income rate will be 515,250. This is an income I earned over a 5 months period. So divided by 5 gives you monthly income. Multiplied with 12 gives you annual income. Divided by the amount you deposited. 4.58%. Clear, everyone? Good enough? Okay. What was the second case? Second case of futures was that what if the base rate reduces by 0.6%? Okay. Now what will we do today? Today we will buy futures at 94.78. Do you all agree? Quickly, show some participation. Do you want me to slow down, pace up, or is it good enough? It is very difficult to talk to a laptop screen for 4 hours. If you are finding it easy, have a try someday. So please show some participation so that I know that I am not an idiot talking to an empty screen. There are people listening to me. Please write down something in the chat box. Everyone, all good? Okay, thank you. It is really very difficult to keep talking to a laptop screen. Anyways, thank you. Okay, we will today buy at 94.78. Then what will happen? Then transaction date. On transaction date, you will deposit at the prevailing rate. Prevailing rate will be 3.6% minus 0.3% multiplied by 27 million multiplied by 5 over 12. 3.6 minus 0.3 is 3.3 multiplied by 27 million multiplied by 5 over 12 is 371250. Now over here you can see one thing, you can notice one thing, income over here is more, income over here is less. Why? Because in the first case base rates actually increased, in the second case they actually decreased. But what will happen is that there is one more thing, which is the futures market. Now over here, since the interest rates decrease, my actual income is less, but the futures price, which futures price will I use to close the deal now? 96.60, which means that the futures price or sell value is 96.06. Okay. So now what will happen? We are making a gain, correct? We are buying today at 94.78, selling at 96.06. So 96.06 minus 94.78 is a gain of 1.28. 1.28, I guess. 1.28 is in percentages, so divided with 100. 90 contracts, each contract of 500,000 multiplied by 3 over 12. So 1.28 divided by 100 into 90 into 500,000 into 3 over 12 gives you a gain of 144,000. Since it is a gain, it increases my overall income. So we added in 371250 and we get 515,250. Correct? Again, our effective rate is 4.58%. Is this clear, everyone? Is this clear, everyone? Now, tell me, is this a coincidence that the values are coming same? Is it a coincidence that the value are coming same? Is it a coincidence that the effective rate for both cases is same? Or will it happen every time? Is it a coincidence or will it happen every time? It will happen every time. Why? Because listen carefully. If for example this is not 0.6, if for example this is not 0.6, reduction is 0.5. Let's say the reduction is 0.5 or maybe 0.7, let's say. For example, if the base rate reduces by 0.7, for example, what if the base rate reduces by 0.7? So the new base rate will be 3.5%. 3.5% minus 0.3% will mean that my investment return will be at 3.2%. But on the other hand, this will also change. The expected futures price will also change. Do you agree? This 96.4 will be different. Do you all agree? Are you able to understand? Okay. So if the base rate changes, if the base rate changes, it has two impacts. Number one, the futures price will also change from the above table in the opposite direction, and the investment rate will also change. Okay? No, 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 no. You have to do both. You have to do both. Because the examiner clearly said, you can read over here. Recommend a hedging strategy. Recommend a hedging strategy for the 27 million based on both the facts. Okay. So Even if the answer is same, yes, logically the effective annual rate is same, but you have to show all the workings. Otherwise, the examiner is going to call you again after 3 months to do the second working. So better do both the workings together. Okay? Don't let him call again to do the second working. Do all the workings together in the first time. Okay. So this is done. This was your futures. Okay. All right. Now options. Now options. Now over here in this question, we have two strike prices. Now again, we will do working for both exercise prices. Okay. So how many times will we do options over here in this question? How many times will we do options over here in this question? 4 times. How many times? 4 times. Why? First, we will select a strike price of 94.25. Then we have two cases, 1.1% and 0.6%. Then we will select the strike price of 95.25. Again, we have two things, 1.1% and 0.6%. So there will be 4 workings. Understood? Okay. Which options are we going for? We are going for call options. We are going for call March options. Correct? Are we all together? Okay. We are going to go for call March options, and let's do the case in which options. Okay. I will be slightly quick. Exercise price, futures price. I am doing the case of 1.1% increase first. First is 94.25 and 95.25. 94.25, 95.25. These are the two exercise prices available. And in case of 1.1%, futures price expected is 94.36. 94.36. 94.36. Okay. Sir, can quickly please explain interest rate collars afterwards? Interest rate collar is covered twice or thrice in the last 3 webinars. Okay, let's come over here. We are going for call options. We know the reason logically. We are doing it for 1.1% increase. Will I exercise the option in this case and in this case? Okay, call option means option to buy. Will I buy at 94.36 and sell it at 94.25? Will I buy at 94.3? Call option. Call option means option to buy. Will I buy at 94.25? Will I buy at 94.25 and sell at 94.36? Yes. And will I buy at 95.25 and sell at 94.36? Will I buy at 95? No. Are you all together? Are you all together? I am just doing the case of 1.1% right now. Okay? Lost. Okay. Vicinity, are you with us since start of the session? Are you with us since start of the session? Yes or no? Have you been with us since start of the session? Yes or no? Okay. Do you understand that we are going for a call option? Do you understand that we are going for a call option? Do you understand that why we are going for a call option? Okay. All right. In this question, we have two different exercise prices. What is exercise price? In the first case, exercise price is 94.25. Call option means that if I want, I can buy futures at 94.25. Agreed? Exercise price in first case is 94.25. Call option means that I can buy at 94.25. Yes or no? Call option means option to buy. Exercise price means the applicable price. So 94.25 means that if I want, I can buy the futures at 94.25? Yes or no? Quickly. So will I buy at 94.25 and sell at 94.36? Is it beneficial for me? Buying price is lower, selling price is higher. How did I get the selling price? We have worked out the futures price over here, 94.36. So will I buy at 94.25, exercising my option, and sell at 94.36? Yes. In the second case, will I buy at 95.25 and sell at 94.36? No, it will be a loss making thing. Correct? Now, the premium is always paid. Okay, when is premium paid? Today or transaction date? What will happen today? Today is the payment of premium. Today you will pay premium. What is the amount of premium? Amount of premium is 0.545 and it is in percentage, or 0.098, it is in percentage. So 0.545%, 0.545% multiplied by, there are 90 contracts, multiplied by value is 500,000, multiplied by 3 over 12. Do you all agree? 0.545 divided by 100 multiplied by 90 multiplied by 500,000 multiplied by 3 over 12. What is the amount of premium in the first case? What is the amount of premium in the first case? If the exercise price is 94.25, my payment of premium is 61,313. Correct? In the second case, if I go for exercise price 95.25, 0.098, premium is 0.098. So it will be 0.098% multiplied by 90 multiplied by 500,000 multiplied by 3 over 12. So 0.098 divided by 100 multiplied by 90 multiplied by 500,000 multiplied by 3 over 12 gives you 11025. Agreed? Is it clear, everyone? Okay. Now, in the first case, okay, now transaction date, transaction date, transaction date, transaction date, transaction date, transaction date. On transaction date, I will do the actual deposit. I'm not working it again for 11%. My actual deposit return is 562,500. 562,500. 562,500. Correct? On transaction date, the earnings from the original deposit are 562,500. And what about options? In the second case, I will let the option lapse. But in the first case, I will exercise my option. Exercising my option gives me a gain of 94.36 minus 94.25 divided by 100 multiplied by 90 multiplied by 500,000 multiplied by 3 over 12. 94.36 minus 94.25 divided by 100 multiplied by 90 multiplied by 500,000 multiplied by 3 over 12. So the gain is 12375. Correct? So in these cases, in case number 1, 562,500 is my income. 12375 is also my income, but 61313 is my premium cost. 562,500 plus 12375 minus 61313. So this is 5136, 513,562. In second case, 562 500 is my income and 11025 is my cost. 562 500 is my income and 11025 is my cost. So it will be 551475. Is it clear? Is it clear, everyone? Can you calculate the effective annual rate now? Calculate the effective annual rate now, please, quickly. For the first case, it will be 513,562 divided by 5 multiplied by 12 divided by 27 million into 100%. 513,562 divided by 5 into 12 divided by 27 million into 100. This is 4.56%. And likewise for second case, 551475 divided by 5 into 12 divided by 27 million into 100, 4.90. Is this clear? Have we completed the question? Yes or no? No. What is pending? We have to do it if the rate decreases by 0.6. Okay? Examiner doesn't call us? Yeah. So the examiner doesn't call us. Now the second time, again things will be very similar. Let me do it over here. Again, you have two exercise prizes. Exercise prize 94.25, 95.25 and futures price. Futures price over here in the second case was how much? 96.06. Okay, Devya, which calculation? Effective interest rate. Which calculation? Okay, let me do it with you. 551475 divided by 5. What is 551475 divided by 5? Quickly, Divya. Correct. Now multiply it with 12. Multiply it with 12. It will be 1323540. Now divided with 27 million and multiplied with 100. Okay. All right. In second case, futures price is 96.06 and 96.06 in both cases. Devya, is it okay? Yes, 4.902. Okay. Will I exercise the option? Will I exercise the option? Will I buy at 94.25 and sell at 96.06? Yes. Will I buy at 95.25 and sell at 96.06? Yes. Okay. All right, the premium amounts in both cases. Today, today what will we do? Today we will pay premium only, same working. So same amount 61313 and 11025. Then transaction date. On transaction date, we will do the original deposit. Return on original deposit 371250 and 371250. Then gain or loss on gain on the future trading. So I believe you can do it now. 96.06 minus 94.25 divided by 100 multiplied by 90 multiplied by 500,000 multiplied by 3 over 12. This is the first case. 203625. And in the second case, 96.06 minus 95.25 divided by 100 multiplied by 90 multiplied by 500,000 multiplied by 3 over 12. In second case, 911125. 1125. Okay. Rest I believe you all can do and complete the question as well. Is it clear, everyone? All right. Now again, do note down my contact number. Okay. Do note down my WhatsApp number. And if you are someone who is not enrolled for the paid batch, you can still have some limited content with you. Those who are paid students, we will have a couple of live classes next week as well. There will be a pre-mock session, there will be a live class, there will be a mock exam, and there will be a grand revision, there will be a mock debrief session. So I believe that effectively we do have probably 4 or 5 classes of 3 hours or maybe 4 hours each still remaining, which means that we will have around 20-30 hours of learning. Also, you have mock exam ahead and you have a grand revision ahead. You have the mock debrief ahead as well. Make sure the 6 important tabs that I have marked are complete as early as possible. No, we don't have live class tomorrow. We will have live class on coming weekend again. Okay, both Saturday and Sunday, both days. Okay. I will share the updated schedule with you. Actually, there have been some changes. But you can say that every Saturday, Sunday, we are going to have a session. Yes, today and yesterday's class are going to be on YouTube tomorrow, that is Monday. But the sessions now onwards will be for paid students only. Also, the mock exam will be marked by me myself. And make sure that the 6 tabs are complete. And I will highly appreciate if you all can give me feedback about today's session. Was it helpful? If you have feedbacks, do share with me. Do let me know how was the session. Do let your friends know if they want to perfect interest rate hedging, because in today's session we discussed both the cases, deposit and borrowing. And if someone watches these sessions, they are going to help them in collars and swaps as well. Also, recent game changer and webinars tab is really important. In that particular tab, I have solved interest rate collars and swaps as well. But before swaps and collars, this session was very helpful. Okay, next week we will probably be discussing either currency hedging because you know that in your exam paper there are 25 marks from hedging area at least. It can either be the interest rate hedging area or the foreign currency hedging area. I have to discuss the case in which we use the lock-in rate and where we trade the futures in case of foreign currency. And also then we will focus on mergers and acquisitions and everything. Also, there have been 4 or 5 live classes in the last few weeks. Do watch them. Last week's live class was very important because we did adjusted present value in detail as well. Thank you so much for being part of this session. I will highly appreciate if you can give me your honest and genuine feedback about today's session on my WhatsApp. Thank you, everyone, and bye from my side.